Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
February 9th, 2026. Closing price, $2.39. Daily volume, 247,110 shares. Daily change, a marginal increase, 0.42%.
Context is everything, though. We are looking at a stabilization phase, yes. But, we are also looking at a stock that is just significantly depressed relative to its 52-week high of $5.52. We are sitting at the bottom of a very deep valley here.
And that valley is, well, it's the subject of our discussion today. We are analyzing Ceragon Networks, ticker CRNT. The central question before us is pretty stark. Is this company a classic value trap, suffering from a structural revenue inconsistency that will just forever keep its valuation grounded? Or is it a misunderstood technology leader currently coiled for, say, a five-fold valuation increase by 2036?
It's a question of risk versus reward. You look at the chart and you see a coiled spring. I look at the same chart and I see a company that has lost over half its value because of a, frankly, recurring inability to predict its own revenue stream.
Well, I see why you'd think that, but let me offer a different perspective. I believe the current price reflects a temporary, almost emotional misunderstanding of a specific revenue deferral in late 2025. My position is that Ceragon has fundamentally pivoted. They are no longer just a hardware vendor selling radios. They are becoming a high-margin, end-to-end connectivity provider poised for the 5G advanced and eventually the 6G eras. The market is looking backward. I'm looking at the backlog.
And I just come at it from a different way. That revenue deferral you mentioned isn't just some bookkeeping anomaly. To me, it highlights a critical structural weakness, extreme customer concentration. When one customer sneezes, Ceragon catches pneumonia. Despite their technology, and look, I will grant you, the technology is impressive, the competitive landscape is just filled with giants. We're talking Huawei, Ericsson. I believe the 5x growth thesis is, let's just say, overly optimistic given the geopolitical friction and the sheer weight of that competition.
Okay, so let's open up the position statements. I want to be very clear about why I am bullish on this stock at $2.39. The core of my thesis is that the market has violently overreacted to the news from the fourth quarter of 2025.
The news being that they missed guidance?
Because of a deferral, yes. Let's look at the evidence. In the final weeks of December 2025, a large North American customer shifted a scheduled delivery into 2026. Now look, if that customer had canceled the order, I would agree with you, but they didn't. Not only was it not a cancellation, but that same customer actually placed more orders during that same period. The market saw a revenue miss. I see a backlog explosion.
But you can't pay dividends with backlog. You pay them with recognized revenue.
That's true, but backlog is the best indicator of future health. The North American backlog exiting 2025 nearly doubled compared to the end of 2024. That is a hard number. It provides unprecedented visibility for the 2026 revenue guidance, which management has pegged between $355 million and $385 million. The company is healthier than the chart suggests. This pullback to the $2 range is a buying opportunity before that backlog clears and the revenue hits the books.
I'm sorry. I just don't buy that it's that simple. Let me tell you why. You're framing the backlog growth as this purely positive indicator. I view it as a silver lining on a very, very dark cloud of volatility. The core thesis of the bear case is that this reliance on Tier 1 operators, it creates lumpy financials. It is just inherently unstable.
All infrastructure projects are lumpy.
Not to this degree. When a single customer changes a schedule and the stock collapses from $5.52 down to $2.39, that indicates a real fragility in the business model. And we have to talk about the risk factors. Ceragon has roughly, a 10% market share? They are fighting giants. Huawei has 35%, Aviat has 21%.
Market share isn't the only metric that matters.
It matters when you're trying to survive. A best-of-breed technology does not always win against these bundled solutions from diversified giants who can, subsidize their losses. The valuation is low for a reason. It is low because the market is pricing in the risk that Ceragon just gets squeezed out by the ecosystem players.
That is a fair concern, but it assumes the technology doesn't matter in the transport layer. I would argue that in the era of 5G advanced, technology is the only thing that matters. And this brings us to the core of the debate, and specifically the technology moat. You mentioned Huawei and Ericsson. I want to talk about the Neptune SoC.
The system on a chip?
Exactly. This is their superpower. Most of Ceragon's competitors, they rely on merchant silicon off-the-shelf chips. Ceragon designs their own. The Neptune SoC was launched into mass production in late 2025, and we need to look at the specifications because they aren't just incremental, they're transformational. It offers an 87.5% energy savings compared to the previous generation.
Energy savings are good, sure.
They aren't just good, they are crucial for OPEX. I mean, power consumption at the tower site is one of the biggest costs for operators. So if you can cut that by nearly 90%, you win the contract. And furthermore, Neptune supports 16 QAM modulation.
Okay, for the listeners who aren't network engineers, can you clarify the significance of that?
Right. It allows for fiber-like wireless speeds. So we're talking about up to 4 gigahertz of channel bandwidth. This is necessary for the massive data throughput required by 5G advanced and, eventually 6G. By developing this in-house, they are 2 to 3 years ahead of competitors who are just waiting for Broadcom or Qualcomm to release a similar chip.
That is a compelling argument, I'll give you that. But have you considered the sustainability of that lead? You say they are 2 to 3 years ahead. In the semiconductor world, that's a lifetime, but it is also a target. Can a smaller player like Ceragon really sustain that R&D cycle against an Ericsson or a Huawei over a full decade?
They have done it so far.
But the stakes are getting higher. Developing proprietary silicon is incredibly expensive. If the giants catch up in efficiency, what if Broadcom releases a chip next year that matches Neptune? Ceragon's specialist advantage just evaporates overnight. Then they are just a smaller hardware vendor with higher overheads. There's a risk of technological obsolescence here that is, it's significantly higher for a company that bets the farm on its own chip architecture.
I disagree that they're betting the farm solely on the chip. The chip enables the strategy, but the strategy itself has shifted. This brings us to our second point of contention, the strategic pivot. This company is changing its DNA. It is no longer just selling radios, it's selling services.
Every hardware company says they want to sell services. That's the standard line to get a higher PE multiple.
But Ceragon is actually executing on it. Look at the acquisition of E2E Technologies. This expanded them into private networks, and they added over 30 new customers in 2025 alone. 75% of those were in private networks. We are talking about mining, energy, public safety.
30 customers is a start, but is it really material to the bottom line?
It is when you combine it with managed services. They're using this digital twin technology, AI optimization to simulate networks. They signed a $2.7 million contract with a Colombian operator specifically for this. They have a deal with a global e-commerce giant for video surveillance. This is high-margin, recurring revenue. It's the thing that stabilizes the lumpiness that you are so worried about.
I'm just skeptical about the execution risk. Shifting from hardware, which is a lower margin logistics game, to services, which is a high-touch, software-driven game. That is culturally very difficult, and we cannot ignore the geopolitical friction.
You mean because they are an Israeli company?
Precisely. We are looking at a $5 million operational expense headwind expected in 2026 purely due to the volatility of the Israeli shekel. That is money straight off the bottom line. And furthermore, in a polarized geopolitical world, there are markets where being an Israeli tech firm is a disadvantage compared to, say, a neutral European player like Ericsson. They face friction that their global competitors simply do not have to account for.
That's true, but they're mitigating that with a global footprint in India and North America. And frankly, the valuation already accounts for that risk. Which leads us to the final and perhaps most important topic, the path to a quintuple valuation, the 2036 outlook.
Okay, you're projecting a 5-fold increase. Walk me through the math on that.
It's actually quite conservative math. To hit a 5-fold return from $2.39, We need a share price of roughly $11.95. That requires a market cap of about $1.06 billion.
And to get to $1 billion market cap,
They need to reach roughly $1.1 billion in revenue by 2036. So that implies about an 11.5% compound annual growth rate in revenue. Now, keep in mind, the market itself, the mobile backhaul market, is projected to grow at 11 to 15%. So they don't even need to beat the market. They just need to match the market's growth.
And what drives that growth?
Two massive catalysts. First, the U.S. BEAD program, $42.5 billion for rural broadband. Ceragon is perfectly positioned for that. Second, the Indian market recovery. They already have a $100 million run rate there. So if they simply execute on these existing trends, and if the market re-rates them as a software services company with a PE of, say, 15, which is reasonable, the math works. 15 times earnings on $88 million in net income gets you to $1.3 billion. That's more than a 5x return.
See, I challenge the assumption of smooth growth. You are assuming they can just ride the wave of the total market. But if you look at the divergence in the data, the microwave transmission equipment segment, that's only growing at 3.4% CAGR.
But Ceragon isn't just microwave anymore.
That is the bet. If they remain a microwave company, they grow at 3%, and this stock goes nowhere. They need to win in the high-growth segments, private networks and 6G, to hit that 11.5% target. If they miss that niche, they miss the target completely.
But look at the floor.
The Aviat offer?
Exactly. In 2022, Aviat Networks attempted a hostile takeover. They offered $3.08 per share. The board rejected it as inadequate. Today, you can buy the stock for $2.39. You are buying it for significantly less than a competitor was willing to pay 4 years prior, and the company is fundamentally stronger now than it was then.
It sets a floor. I agree with you there. But it also serves as a warning. The market has kept the price below that offer for a reason. Investors have fatigued. The Aviat benchmark suggests undervaluation, sure, but it also suggests that the market doesn't believe management can unlock that value on their own. The road to 5X is paved with execution hurdles, and Ceragon has tripped over those hurdles before.
Let's move to our conclusions. I want to summarize my stance. Ceragon Networks is at a definitive turning point. The technology, specifically the Neptune SoC, is ready and it is shipping. The backlog is record-breaking, providing a visibility we haven't seen in years. The shift to private networks is actually working. You can see it in the customer wins. The price action of $2.39 is looking backward at a delay, while the smart money should be looking forward to the 2026 breakout.
And here is my summary. While the technology is solid and the Neptune specs are impressive, the risks are structural and they are persistent. Customer concentration means the lumpiness isn't going away. Geopolitical headwinds are real and they are costly. And the difficulty of fighting giants like Huawei and Ericsson with a smaller balance sheet makes this a very high-risk play. I will concede that the Aviat benchmark suggests the stock is cheap, but cheap stocks can stay cheap for a very long time if they fail to execute.
We will find out who is right very soon.
Indeed. I think we both agree on one thing. The performance in Q1 and Q2 of 2026 will be the decisive truth teller.
Specifically, we need to see that North American backlog convert to cash. If it does, the bull case activates.
And if it gets deferred again, the bear case is confirmed.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.